Ever feel like you're playing catch-up in the stock market, always a step behind the big players? It's like everyone else knows a secret language you don't. Well, guess what? They do. But don't worry, I'm here to let you in on it. In this video, we're diving deep into the fascinating world of candlestick patterns, the secret code of the markets. Understanding these patterns can be the difference between leaving money on the table and making smart, informed trades. Over the next few minutes, I'm going to break down 5 of the most common candlestick patterns in a way that anyone can understand. We'll cover what each pattern looks like, what it tells you about the market sentiment, and most importantly, how you can use this knowledge to your advantage. By the end of this video, you'll be able to read the markets like a pro and make smarter trading decisions. Alright, let's kick things off with the Doji candlestick. Now imagine this, you're thinking about buying a stock, but you're not quite sure. You hesitate, weighing the pros and cons, maybe even pacing back and forth. That's exactly what the Doji pattern represents in the market indecision. Visually, the Doji looks like a plus sign or a cross. It has a very small body or sometimes no body at all, with wicks of varying lengths on either side. This tells us that the opening and closing prices were virtually the same, indicating that buyers and sellers were equally matched in that trading session. Now here's the key takeaway. The Doji is a neutral pattern. It doesn't necessarily predict whether the price will go up or down next. Think of it like the market taking a breather, catching its breath before its next move. So, what do you do when you see a Doji? Don't jump the gun. The worst thing you can do is make a hasty decision based on this single pattern. Instead, be patient and wait for confirmation. Look at the next few candlesticks that form after the Doji. Do they indicate a continuation of the current trend, or a potential reversal? Remember, trading is all about managing risk and making calculated decisions. The Doji is a valuable signal, but it's crucial to consider it in context with other indicators and market trends. Don't let indecision lead to a bad trade. Next up, we have the hammer candlestick pattern, a signal of hope in a downtrend. Imagine a blacksmith hammering away at a piece of metal. Each strike represents selling pressure pushing the price lower, but then, bam! The hammer hits a point of resistance, and the metal refuses to budge any further. That's essentially what the hammer candlestick tells us. It's a bullish reversal pattern that typically appears at the bottom of a downtrend, signaling a potential shift in momentum. The hammer has a small body at the top of the trading range, with a long lower wick at least twice the size of the body. This indicates that sellers drove the price down during the session, but buyers stepped in with force, pushing the price back up near its opening level. Now here's a pro tip. Always pay attention to trading volume when analyzing candlestick patterns. A hammer candlestick with high trading volume is a much stronger signal than one with low volume. Why? Because it shows us that there was a significant amount of buying pressure driving the price back up. Think of it like this. If you see a single person trying to push a car uphill, you might not be too convinced. But if you see a whole group of people pushing together, you'd be more likely to believe they could move it. The same logic applies to trading volume. So the next time you spot a hammer candlestick with strong volume at the bottom of a downtrend, pay close attention. It could be a sign that the bears are losing their grip and the bulls are ready to take over. Chapter 3. Just like the hammer signals a potential reversal in a downtrend, the shooting star candlestick pattern warns us of a potential reversal in an uptrend. Imagine a balloon floating effortlessly higher and higher. It seems unstoppable, reaching for the sky. But then, suddenly, it bursts, and the air rapidly escapes, sending it plummeting back down to Earth. That's the visual analogy I want you to keep in mind when you see a shooting star pattern. It's a bearish reversal pattern that typically appears at the top of an uptrend, indicating that the bulls may be losing steam. The shooting star has a small body at the bottom of the trading range with a long upper wick at least twice the size of the body. This tells us that buyers initially pushed the price higher during the session, but sellers quickly took control, driving the price back down near its opening level. Now here's the thing about shooting stars. They're not always the most reliable indicator on their own. Sometimes a shooting star can simply represent a temporary pause in an uptrend, rather than a full-blown reversal. That's why it's crucial to combine the shooting star with other technical indicators for stronger confirmation. Look for things like overbought conditions on momentum oscillators, bearish divergence patterns, or resistance levels on the chart. The more evidence you have to support the bearish reversal signal, the more confident you can be in your trading decision. Remember, trading is all about managing risk. Don't rely on a single indicator in isolation. Instead, use a confluence of factors to make informed decisions and protect your capital. Chapter 4. Now let's talk about a powerful bullish pattern that can signal a significant shift in momentum, the bullish engulfing pattern. Imagine a small wave rolling towards the shore. It seems insignificant, barely noticeable. But then, Out of nowhere, a massive wave appears behind it, completely engulfing the smaller wave and carrying it towards the beach with incredible force. That's the kind of energy and momentum we're looking for with the bullish engulfing pattern. It's a two-candlestick pattern that occurs when a small bearish candlestick is followed by a large bullish candlestick that completely engulfs the body of the previous candle. This pattern indicates that sellers were in control during the first candle, but buyers stepped in with overwhelming force during the second candle, driving the price significantly higher. Here's a pro tip for using the bullish engulfing pattern effectively. Look for it at the bottom of a downtrend or during a period of consolidation. When you see this pattern emerge after a prolonged downtrend, it can signal a potential trend reversal and the beginning of a new uptrend. Think of it like this. The downtrend represents a period of weakness and selling pressure. The bullish engulfing pattern, on the other hand, represents a sudden surge of buying interest and a shift in market sentiment. When these two forces collide, it can create a powerful move to the upside. Of course, like any candlestick pattern, the bullish engulfing pattern is not foolproof. It's essential to consider other factors, such as trading volume, support and resistance levels, and overall market conditions, before making any trading decisions. Chapter 5. Just as the bullish engulfing pattern signals a potential shift from sellers to buyers, the bearish engulfing pattern indicates a potential shift from buyers to sellers. Imagine a bright sunny day. The birds are singing, the sky is clear, and everything seems perfect. But then, out of nowhere, dark, ominous storm clouds roll in, completely engulfing the sky and casting a shadow over the once peaceful landscape. That's the visual I want you to associate with the bearish engulfing pattern. It's a two-candlestick pattern that occurs when a small bullish candlestick is followed by a large bearish candlestick that completely engulfs the body of the previous candle. This pattern tells us that buyers were in control during the first candle, but sellers took over with a vengeance during the second candle, driving the price significantly lower. Here's a key takeaway for using the bearish engulfing pattern effectively. Look for it at the top of an uptrend or during a period of distribution. When you see this pattern emerge after a prolonged uptrend, it can signal a potential trend reversal and the beginning of a new downtrend. Think of it like this. The uptrend represents a period of strength and buying pressure. The bearish engulfing pattern, on the other hand, represents a sudden surge of selling pressure and a shift in market sentiment. When these two forces collide, it can create a sharp move to the downside. Remember, no candlestick pattern is perfect, and the bearish engulfing pattern is no exception. It's crucial to consider other factors such as trading volume, support and resistance levels, and overall market conditions before making any trading decisions. So there you have it, 5 powerful candlestick patterns that can give you an edge in the markets. We covered the Doji, which signals indecision, the hammer and shooting star, which can indicate potential reversals, and the bullish and bearish engulfing patterns, which show strong shifts in momentum. If you found this helpful, make sure to like, comment, and subscribe for more trading tips. Let me know in the comments which pattern you're most excited to start using in your own trading. Remember, every great trader started with the basics. Master these patterns, and you're already ahead of the game. Now get out there and start reading the markets like a pro.